We are live on LinkedIn and YouTube, much earlier than expected. I'm going on vacation in a few hours and needed to push this up earlier so I could do that. And thankfully, I'm here with my good friend Doug Hagren. Hey, Doug.
Morning, Kirk. How you doing today?
I'm doing great. Doing great. So, hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'm joined with my good friend Doug Hagren. Let's just dive right in here. I know we're getting close to the end of tax season, so Kelly could not join us. He's, as he claims, he's in the red zone. He's a few days away. I think the deadline is the 18th, if I'm not mistaken. So, those of you who haven't done your taxes yet, you're probably on extension. So, if you have a good accountant, you're on extension. So, but yeah, I just want to dive right in. So we got a bunch of stuff to talk about this week. I'm going to try to keep it short so I can go on vacation and get Doug back to his stuff here. But we have this week we had the CPI number, which was really interesting. It came in at 5%, and it was 6% last month or last time. So what's fascinating to me is that the markets immediately went up and then went down, and it was basically a non-starter for the markets. I think the markets had expected 5.1, we got 5. So really kind of a non-starter for numbers. Remember, I don't know if those of you remember, a few months ago we were talking about how inflation is going to go to zero by the end of the year. I don't know if it's going to go to zero, but I could see how it's possible. And just based on real estate and everything that's going on, it's very possible that could happen. I don't, honestly think it's going to happen because in order for that to happen, a lot of other things have to happen. However, it is possible. So I just want to throw that out there. And Doug, any thoughts on the CPI numbers? I mean, it was just kind of a non-event. It was weird.
Yeah, I mean, it came in with we talk about things being priced in, and there was no surprises. Powell didn't come out with anything that Wall Street wasn't expecting. So yeah, it would be a non-event. I will say that in talks of the CPI or inflation potentially going to zero, I think it's something we've said for quite some time is that listen, with a lot of the different things that are going on, with a lot of the work that the Fed's trying to do to raise interest rates to squeeze down inflation, a lot of the trend lines that were happening over the last 18 months, if they all accumulate, not accumulate, sorry, but they all call I can't speak today.
Culminate.
Culminate. Thank you. I knew it was in there. I just mixed my vowels up a little bit. But if they all culminate, it is a deflationary pattern because you start to get to a point where people can't afford the housing, they can't afford food, they can't afford this. Guess what's going to happen? It starts to eat into the budgets to the point in which all of a sudden now you start adding in jobs, and we know in Silicon Valley there's been a lot of job losses. All right, people don't have the money, they're not going to pay those prices anymore, and that's a deflationary effect because ultimately then the prices and things have to come down to what is going to be affordable to the public. And so, I mean, I'm with you, Kirk. I don't think it's going to happen. But ultimately, as you're mentioning, with some of the things that we're seeing out there and some of the metrics, if some really bad things happen, deflation sounds great on the surface, like great. Oh yeah, prices are going down, everything's cheaper for me. But it is not good from the aspect of the broad economy. And it'll be a telltale sign that some really bad things are happening.
Yeah, and just for reference here, all the things we've been talking about, I think what you tend to see is you tend to see a lot of things kind of thrown around in the news, and newsletter writers and all the people that are whipping up fear with everybody. So if you read newsletters, you watch the news, wherever you get your data, they're probably scaring the pants off you with whatever they're saying, right? Market's going up, market's going down, whatever. They're scaring the pants off you. And I think one of the challenges is, when people get into that mindset, they become afraid. They think that the world's going to end, and what tends to happen is people make extreme statements. Oh, the market, we're going to have hyperinflation, or we're going to have a depression, or the dollar is going to go to zero, and all these things. Well, the reality is probably more in the middle, right? And we made that statement a few months ago that the CPI is going to go to zero because it's possible, right? It's an extreme statement. It got your attention, but the reality is this probably not going to happen that way. In order for that to happen, a culmination of a bunch of things have to happen to get there. And it's unlikely, but it's possible. And I say it's possible because I want people to understand how I use that as an example to get your attention to explain how CPI works, why it works, and why it moves, right? Because people just think, well, I'm getting 20, 30% inflation in my food. Why is it only showing 5? It's showing 5 because it's such a small percentage of the CPI, right? It's not that they're lying to you. They probably are. I mean, let's be honest. But besides that, it's not that. Like there's a calculation. It's done in a certain way. It's not like, you're confusing all of the economists around the world. Like they're pretty public. A percentage of this. Now how they do the actual calculations is a totally different story, but they give you the numbers. 45% is housing. That's like close to half of the CPI is housing. So if housing's dropping 20% this year, what do you think is going to happen in the CPI, right? So that was my point of what I was saying a few months ago is not that it's going to hit zero. It's directionally that's where we're going. And it doesn't mean that we're not going to get inflation, right? So you know that you have inflation at the store. That's obvious. We're all seeing it. But we're all seeing deflation at the same time. And I think the challenge is you have to look at these. I look at things in like, let's just say at least 2 buckets. You have goods and services. Let's call them goods, right? Things you buy at the store, food, items, whatever it is. You have inflation. Obviously, we have inflation. Nobody's disputing that. Even the government's not disputing it, right? So you have that inflation, right? Let's say it's 20, 30%. Like, I'm not going to argue the numbers. Let's say it's 20, right? Okay, you have 20% there. You have college, which actually is a little bit lower this year, maybe 7%. It's still high, but it's lower than it was. But then you have asset prices, which dropped 20% last year, right across the board, 20, 30%, depending on which index and market you're in. It was a big drop. It was inconsequential, but it was still a big drop. And so you have asset prices declining. That's deflationary, right? You have inflation here. You have deflation asset prices, which you could call it stagflation. We're not going to call it that officially, but so you have deflation asset prices, and real estate hasn't even started to decline yet, and that's the biggest asset price decline that we're going to see, and we have to because that's how the numbers line up. So real estate nationally should probably be down about 20% this year. That's going to have a big impact on the CPI. We've only started to see that. So you have deflation, inflation at the same time. So when people say, "Oh, we have inflation, deflation," it's such a general term. It's like saying people are smart or people are dumb. Like, obviously, not all people are smart, not all people are dumb, right? Like, but that's a general statement. So when people talk about inflation, they make a general statement. That's not how inflation works, right? It's not. You can come up with the CPI and it can be a general number, and you could argue whether it's accurate. But the reality is you have to understand what happens within that CPI. You have inflation and deflation. So, what tends to happen is, for the last, 15 years, we had, close to deflation. It was stagnation, I would call it. Yeah, we had 2% or whatever it was. You could argue the number. I would argue is less than they claim. But the point is it was deflationary, right? Highly deflated. It was low inflation. That was great for asset prices. That was asset prices are going through the roof. Nobody was calling inflation, saying we're going to have high inflation because asset prices are going up. Nobody was saying that, but that's what was happening, right? But people weren't saying, "Oh, we're going to have high inflation on goods and services," because we didn't. If anything, it was deflationary, right? So they tend to move opposite of each other, and when you have asset price inflation and good and service price deflation, that's good. We all love that, right? Oh, things are cheaper, I'm making more money. But when it's the opposite, it hurts. Oh, my asset price has dropped 30%. So instead of $1,000,000, I've got 700,000. And now all of a sudden my goods and services went up 30%. So now not only do I have less money to retire, but it costs me more to retire. So that it's like a double whammy, right? But that's typically how it's been operating, and I think you have to think of it in that way, right? So, so just understand that dynamic with inflation and deflation, because you're hearing a lot from other people, and most times it's not even accurate. So, Doug, I don't know if you want to say something. I want to jump into the charts here.
No, let's go. Let's jump right in.
Okay. So this is a chart we were touching on last week. The S&P 500 returns starting around the Fed rate hike cycle. And this is the last 70 years. Okay. So I point this out because this is basically a Monte Carlo simulation, even though it's not. It's similar in the sense it shows the variance of the different 70 years. Like they just put it all on a chart and they say this is the range. Well, as you can see, it's actually gone lower. Now, I've seen a lot of charts that say, oh, at the start of a rate hike cycle, the markets tend to go up. Well, that's not entirely true. And I point this chart out. I didn't have enough time to talk about it last week, but I point it out because it's really important. So think about it this way. If you're looking at a chart and it says, well, evidence is undeniable that when the rates start dropping, asset prices start going up. Well, is it the chicken or the egg? Now, I bring this up because let's think back to 2008. 2008, they were raising interest rates up until basically the markets broke. In 2099, they were raising interest rates until the market broke, right? Once the market breaks, well, now you have to start lowering interest rates because you're going to have a big disaster ahead of you. You can't have high interest rates and a crashing stock market, right? The Fed doesn't want that. I'm not saying they won't do it, but I'm saying they don't want that. So once the markets start to crash, they start dropping rates. At which point, okay, well, I need to keep dropping rates because the market's going to keep going down, right? So the market is independent of this, even though it's related. The market's going to do what it's going to do. So right now, interest rates are high and they keep raising rates, and the market is just sitting here. So maybe they don't. Maybe they just keep them where they are. There's no reason for the Fed to drop rates here. There just isn't. So if you look at this and say, if you look at a chart and say, well, because they're starting, because they're starting the rate hike cycle, or they're starting to drop rates, or whatever it is, you're looking at the data. Correlation versus causation comes into play. It is not causative just because it's happened in the past. It's correlated. You can't deny that it's correlated. You can look at the chart. There's some correlations. Is it causative? Not necessarily. So you can't look at a chart and say, well, it's happened in the past, going to happen in the future. It's just not how it works, right? There are exceptions to the rule. I had a friend of mine tell me we were talking about risk management. He's like, oh, look at this ETF. It's basically measures tail risk. It'll do exactly what you want to do, right? And we were kind of talking back and forth. They said, yeah, it will happen unless this one circumstance happens. And not to bore the readers, but basically the circumstance was the market drops and the VIX doesn't spike. So the whole point was it was measuring the VIX. So it's like, oh, well, the market drops, the VIX goes up. That is a correlation, is a very high correlation. But like within a month of that conversation, exactly that scenario happened. Exactly what I thought would happen at some point happened. The market dropped like 15% and the VIX stayed the same. It's highly unusual, but it happens. So basically, if you would use that risk management measure, it wouldn't have worked. Which is why when we look at risk management, you can't just take assumptions from people on the street and say, oh, well, it's happened before, it's going to happen again. There's no guarantee that would ever happen. We talked last week about the bond market and the bond VIX basically spiking right now. No one's talking about it. I mean, being a holder of bonds is a pretty precarious position right now. If you're holding long-term bonds like SVB and Signature Bank and all those others that got basically taken over. But if you have that problem, then you're going to have a big problem, and that's what's roiling the bond markets. Is they're afraid of interest rates continuing to go up. So, I think with the dropping of the CPI, that might put some ease in the Fed. They might be able to just stay pat at the moment. We'll see. We'll see what happens. I mean, we have our corporate earnings coming out starting next week, I believe, and that's going to last for a month, and we'll see what happens. I think corporate earnings are going to be tough, and but moving forward, we'll see where that goes. So, any thoughts on that, Doug, before we move on?
Yeah, no, I think that my takeaway on that is, we've said this before. I mean, Powell hasn't come out and said anything different than he's been saying before. So don't fight the Fed. At this point in time, I mean, people have talked about rates are going to go back down. Like you said, what's the point? We really haven't seen the impact significantly of the rate hike on the market. I mean, we saw it on bonds, 12, 18 months ago, but we talked about ad nauseum. Bonds are mathematical. When rates go up, bonds go down. But stocks, a lot more emotional, and there's a lot of emotion. There's a lot of variables. I mean, this, we talk about things like, this time it's different, right? Well, this time it is a little bit different. If we go back to, 15 years ago, we go back to 20 years ago, there's a lot more variables at play in control in the market that we used to have. High frequency trading, much more retail access. We've got crypto embedded in there. We've got lots of, we got more information and more access to the markets, to more people than ever were. You go back 30, 40 years ago, you had to go through a market maker to make all your trades. You had to go through a broker. The more people that have access to the markets, the more systems that have access to the markets, the more computers have access to the markets, the more you're going to potentially see things different in and not correlate to the way they did in the past. And I like what you talked about with that ETF, because we see it all the time with these special products and things that people come out with. Say, look, we've got this science that's going to work. What, I don't know, was it from 10, 15, 10 years ago, Kirk? Momentum. Momentum's going to change everything. We can see when the momentum turns, that's where you want to jump. Well, guess what? Then the systems, the computers overcame that. And I'm not saying momentum isn't a play anymore, but guess what? Now, when the computers can see momentum faster than you and they can reverse faster than you, if you're just playing momentum, it doesn't work the way it used to be. So every time they discover these wonderful patterns that are going to be the next, game changing, strategy, guess what? Just don't get overly hyped about it, because like you said, all it takes is that one or many variables, or just, an adoption of it, that all of a sudden that correlation, that system, that strategy isn't going to work the way it was. And it brings it back down to, ultimately, one of the greatest ways to still continue, and we talked about this before, is technical trading versus fundamental trading. But there, when you come back down to it, investing in good things, investing in things that make sense, is probably at the basic level the right way to invest. And when you try to get too creative, unfortunately, creativity can blow up in your face.
Yeah, no, totally. So, all right, so we're gonna move on here to some other charts here. Let me move this forward. Okay. So this week I want to talk about valuation. All right, we talked about the number one reason stocks go up from here, or down. Right? It comes down to valuation. Valuation is everything. And for the last pretty much, I don't know, 15, 20 years, valuations haven't mattered. If they did, value investors would have done really well. But instead, growth investors did well because people didn't care about valuations. They just cared about growth. And
Value
that,
investors are the dog that keeps getting kicked, Kirk. It has been a long road of misery for value investing.
yeah, they are the redheaded stepchild. They are, black sheep, all of it. And they're smart people. And like I'm not knocking on value because I'm value oriented myself. However, the problem with being a value investor is for 15 years you've been wrong, and it doesn't necessarily mean you're wrong, but you know, and this is actually, I want to use this before we kind of dive into this rabbit hole. There's an important framework that you should realize. Okay, right or wrong doesn't come down to eventually I'll be right. Right? If somebody says, like if, for instance, there's a well-known name, and I won't name him because I don't really want to get sued. He's got more money than me. But he's been telling everybody since 2008 that the dollar is going to go to zero, gold's great, everything's going to implode. You need to short the stock market. You need to be in gold. From 2008 on, basically, he lost his clients an enormous amount of money, and he's still saying the market's going to go to zero. So is he right? Well, maybe 10 years from now, he might be right. But what does that mean for the last, basically, whatever it is, 25 years prior to that? Well, it means you're wrong, right? So just being right at some point means you're wrong, right? So, right and wrong in the market comes down to basically timing, right? Because I could say, hey, the U.S. is going to default in its debt and the CPI is going to go to zero. Well, I could make that statement. If I don't bind it with time, then I'm just making a statement, right? Because I can still be right, right? And think about, this is what Wall Street does. This is a peek behind the curtain. Wall Street will make statements and they won't bind it with time, which basically means that they could be right at some point. Now there are people who make annual predictions, totally like that, right? You could be right or wrong. Somebody could look at your record and say your record is great or your record's terrible. When you just make a statement, don't bind it with time, then you're basically you're pulling a fast one on people. You're doing what we call half truths. So being a value investor is about being patient and making good decisions, and over time things pan out. That's the nature of being a value investor. So for the last 15 years, value investors have been quote unquote wrong. They haven't been wrong. They just haven't beat the market, right? Growth has beaten the market. And people had these wild valuations because of growth stocks, not because of value stocks. Um, so the challenge of growth versus value is sometimes you're really out of favor. Like growth stocks didn't do very well last year, and value did okay, right? They held their own because they don't have as wide of a swing. But I point this out because timing is really important. So when people are going to make lots of statements over the next few years, and if they don't bind it with time, you can just discard that, right? I try to bind my stuff with time. I don't always do it. It's a habit. Sometimes you make a statement and you don't bind it with time. But like the CPI, I said by the end of the year, right? And if I'm wrong, I'm wrong. I'm not, 10 years from now, I could be right, but I would consider myself wrong if it was 10 years from now. But a lot of people don't. They'll come back and be like, 10 years ago, I said this is going to happen. Like, who cares, right? You've been wrong for 10 years. Why do I care? No one's been paying attention. Anyway, so getting back to this. So I want to talk about I'm going to show you guys a bunch of valuation indicators. This is probably the best episode you're going to see all month. Okay. I'm going to, not from us, because every episode's great and every episode's better than the last. So if you don't see the next one, you're going to miss out. But that being said, this is going to be one of the best things you can listen to if you haven't seen this and you haven't aggregated this. I'm putting together a bunch of different valuation metrics. This is what I and a bunch of other Wall Street people that anybody of note kind of look at as metrics. Now, it's not all of them. There are more, but I didn't want to overwhelm people. So I'm putting together some of the more common valuation metrics. Now, why am I doing this? I'm doing this because what I'm trying to show you is that Doug's been talking for the last, year about overvaluation of markets. Stock markets are high and they're going to drop at some point. Of course, I didn't bind that with time, so I don't want to be a hypocrite, but they should drop. I don't know when they're going to drop, but I know that based on valuation, they should. So I want to go over this and explain valuations, and I want to explain these different indicators just so you can get a sense of what I've been talking about for the last few years. So if you're just listening to some podcasts, go to our website, go to our YouTube channel, go to LinkedIn. You're going to see this live and you'll see these charts. So I apologize to listeners, but I'll talk you through it. So hopefully you'll get something from this. So, all right. So the first one is the Warren Buffett indicator. Now, I use this first because it's Warren Buffett and he's not an idiot. And he uses this metric for his own valuations. Now, so if you look at historically from the 1950s to right around the 90s, the valuations kind of operated within a certain spectrum. So basically 80 to 100% is relatively cheap. Under 80% is really cheap. Over between 100 and 120% is relatively expensive. Over 120 is really expensive. So if you look here in 2000, we reached 159%, basically close to 160%. That was the peak valuation in 2000. If you guys remember, 2000 was ridiculous valuations. This is when companies were going public and they had negative earnings and it was all sorts of crazy. That was 2000, right? And it was only 160%. And then it dropped, after that, and then in 2008 dropped to like 66. That was pretty cheap. Subsequently, it went up to 211%, and that was 2020. 211%. That is double what it should be. That's crazy valuations. Now it's only 150. It's still right around where it was in 2000. Still crazy expensive. So I point this out because according to Warren Buffett's indicator, which I think is reasonable, and I'm going to explain the indicator as well, the markets are extremely overvalued. Extremely. It's not even close. Can they continue to be overvalued? Absolutely. They could stay here for 20 years. I'm not saying that all of a sudden it's going to crash. I'm saying that this is a indicator that we look at, one of many, and say, all right, are the markets overvalued, undervalued? And we use that as to help in our decision making. Because if it was at 32% like it was in the early 80s, I would say let's go all in. Let's borrow everybody's money and go all in because that's cheap, right? That's a difference, right? And at some point, it may get that back to that level. Maybe not. I don't know. But I know it's historically expensive. So when I make decisions, I'd say, all right, how expensive is it? How do we gauge this? All right. So here's basically what the indicator is. It's basically a comparison of corporate equities to GDP. So GDP is basically, gross domestic product. So it's a measure of productivity or economy. And then there's corporate equities. So if corporate equities are expensive to GDP, then this indicator is high. Corporate equities are cheap to GDP, then the indicator is low. So all it's doing is taking a big aggregation of the economy as best it can and saying, hey, here how are stocks valued as a whole compared to the whole economy? It's not perfect, but it's a good rule of thumb, right? I'm not going to dissect this because that's not the point. The point is rule of thumb is this showing me anything? Okay, it's showing me that we're still overvalued. And I've been saying this for a while since COVID. It's been overvalued. It's still overvalued compared to COVID. All right, so moving on here. The next one is from Ned Davis Research. So this is an aggregation of a bunch of different factors. I'm not going to go into them all, but basically, if you look at this, it just shows the data set, it shows the recent value, and then it basically in different colors will show you what is it overvalued, undervalued. So it looks at 2, 4, 6, 8, 10, 12, 14. Okay, we look at 16 factors. Median price to earnings, price to gap earnings, price to Shiller earnings, PE, market value, price to it goes through all these different metrics, right? Price to sales, price to book, dividend yield. So it looks at all of these, and then it looks at the historical data, right? So it's just comparing it, right? It's just saying compared to the historically, is this cheap or expensive? More than half are extremely overvalued. Some of them are only moderately overvalued. And then, it goes to slightly overvalued and then neutral valuation, then it goes to undervalued. So it's basically showing by almost every metric, it's either extremely or moderately overvalued.
I don't see a lot of Christmas colors there, Kirk.
Yeah, well, we need some green, Doug. There's no green in there, and that's part of the problem, right? It's a lot of red. It's not a lot of green. So
that's right.
All right, so that's that chart. The next one is the Shiller PE, which is one of those, but it shows it graphically. So it shows you on Black Tuesday it was 30, and then subsequently it was close to 5. It shows Black Monday, which was like 17. In 2000, it went up to close to 45. In 2008, it went down to about 15, only 15, which is interesting. Then you look at COVID, it went up to 37. Now it's at 29. So it's at 30. We're basically right now, the Shiller PE is the same number as it was on Black Tuesday, which was basically the day before the stock markets crashed in 1929. That's the valuation. We're at the same valuation. It is still really overvalued, even though it's down from the peak of around 37. So yeah, it's come down, but it's still really expensive.
Kirk, I want to make a note on some of these charts you're showing. Is that let's go? I mean, obviously, you can see how bad 2000 was, and no question, probably some of the worst valuations in history. That's why companies that were worth billions of dollars basically evaporated overnight because they had no substance. But the other thing I think of note is 2020. Now, 2020, the markets got rattled because of COVID. But what I think a lot of people don't recognize about 2020 is the markets were already primed to get rattled anyway. COVID was just the spark that lit the fuse, right? Because going in from 2019 to 2020, if you look at where these metrics already were in terms of overvaluation, price to earnings, and things like on these different charts, 2020 was going to potentially be a fairly rough year anyway, based on the metrics that were already in place. COVID just took that to a different level, right? So I think a lot of people think COVID is what did the market in. A lot of people, I know, Kirk, you were doing this. A lot of people were prepared going into January of 2020 to be defensive in the first place. It just all of a sudden when COVID hit, it would just help to quantify the logic behind it. And obviously it helped to make a lot of people who were making some fairly smart moves look incredibly intelligent very quickly. Yeah. But 2020 was a really overvalued year to begin with.
Yeah, and it's funny because I don't always like looking at certain metrics because sometimes the metrics go off the chart. So this is an example, and it actually doesn't show in this one. So I don't remember if this is this might be the 10-year. So if you look at some metrics, actually in 2008 and 2009, it showed like I think it was the PE, it was up like 180. And the reason was, it wasn't because everything was overvalued. It was because if you think about it this way, like 2008 was a disaster, right? The numbers are all over the place, the valuations are all over the place, and you had it happen in a short period of time, right? You had it happen in like a few months, and everything fell apart. Well, you can't really rely on the numbers at that point, right? Because you're still looking at old numbers and you're comparing it to new numbers or new prices. So it's not really a match. So you saw this huge spike in PE. It wasn't reasonable. But anyway, because you could say, well, the prices are still above zero and the earnings drop below zero. So when you see spikes like that, you have to ignore it. 2000 was reasonable, but when you see a big spike up in some of these numbers, you just have to ignore it because it's obviously not accurate in that sense. So here's another one. So here's the S&P 500 total return by decile. So decile is basically 10 different tiers. So it's looking at decile 1, decile 10. So I want to explain this to listeners. Basically, it looks at over like the last 100 years, 114 years, the average PE to begin with and the average ending PE for a period. So basically what it's measuring is, what is the average return based on where you are? Okay, now let me explain this better. As of today, we're in the first decile, which means that on the average return, you should get about 1.3% a year based on valuations. Okay. So over the last 114 year periods, every time it was in the first decile, you would get about 1.3% return a year. That's your expected.
What are banks paying right now, Kirk? But 3-4%, 5% money market, depending on where you're at?
No, banks are still paying 33 basis points.
Well, not the banks, but money markets out there.
Well, treasuries are getting like 4 and
right.
4.5.
So that doesn't look very good when you compare it to risk-free.
Right. So if you're looking to invest in equities here, you're shooting yourself in the foot. You're behind. It's like investing in tech stocks in December of '99. Yeah, you can invest in them. It might take you 20 years to start making money on them. And that's the point, right? Is that what are your prospective forward returns going to be? Yeah, you could make 100% return this year, and then next year it goes down and doesn't come back for 30 years, right? Like, so my point is you can look at it and say, well, it's wrong because it happened. But if you look over a full market cycle, and that's how you have to look at it, a boom and a bust, because it always happens. Like, we haven't solved the problem of boom and bust cycles in the economy, and I don't think we should, because it actually serves a purpose. But the government's trying to get rid of it, of course. So anyway, so getting back to deciles. So right now we're in the first decile, which means your average return should be about 1.3% a year. Okay. Now, if you look at the 10th decile, if we were in that period, you would get an average of 17.2% returns a year. So you want to invest in the 10th decile. You don't want to invest in equities in the first decile. Right now, we're in the first decile. We're in the top, which means your returns going forward are going to stink. So for the next 10 to 20 years, your returns are going to be awful. Now, if the market's up 20% this year, you're going to say, "Ha, you were wrong." That's not what I'm saying. I'm not saying year over year. I'm saying over a full market cycle, that's what your returns are going to look like. Okay. So you want to be below the 5th decile, because then you start getting average returns of 9.6, 12, 14, 15%. That's what you want to shoot for. You don't want to shoot for it now. And I know people are like, yeah, I know, but I need returns. Come on, equities, no whammies. Like, that's how people invest. They're like, hey, I just want upside, no downside. This isn't a casino. That's not how it works. All right, next one. I want to point this out. Somebody marked this up. I don't totally agree, but I think it was a good chart. So it looks at the markets basically from 2000 to to today. So if you see the top of the market prior to COVID, we're still way above that. That was like 30, close to 3,400. And right now I don't know where we are today. We're 40 something. Where are we today? Right now we're at about 4,100. Okay. So we're way above that. And things were expensive prior to COVID. And now we're so far above the number, it's not even funny. So, this here carves out what they think the Fed is going to pivot. I actually don't think that's going to happen. I think that, we would have to have a market crash and a lot of things to happen for the Fed to quote unquote pivot. I don't think they're pivoting. We still have high inflation. Until that goes away, I don't think we're going to have a pivot. I think we might have a moderation. I think we might stay where we are for a while. This is what I've been saying for a while. We'll hit 5.5%, and we'll flatline. We'll stay here until something happens in the economy, and then we'll see what happens. The next one is from GMO. GMO is a very well-known institutional research firm, very highly regarded. And what they do is every month they put this out. It's basically a 7-year forecast, and the reason they use 7 years is because that is a full market cycle. Typically, historically, every 7 years the markets go up and they go down. That hasn't happened for the last 7 years. It's been like 12, but normally, historically, 7-year cycles. So they look at it and say, over the next 7 years, here's what your returns should be. Just what we talked about, the deciles. Well, according to them, over the next 7 years, your U.S. large caps are going to turn negative 1.1%, U.S. small caps negative 1.4%. Who wants to invest in equities? Not me. I don't want to invest in equities if my return is going to be negative 1.1% annually, which over 7 years means it's going to be about negative 7.7%, which I think is pretty rosy. That's a pretty rosy number, I think. I think it'd be worse. But then you look at international, you're looking at 2% and 3.9%, and then emerging markets, which have been high for a while, 5.5% and 8.3%. Well, those are interesting numbers. Now, I'm not saying that I want to invest in emerging markets because they show that, but you should understand relative to other things, emerging markets are a better value than other things. Now, you have a lot of other things. Don't go invest in emerging markets because emerging markets are highly volatile and risky, and you can lose a ton of money if you don't know what you're doing. Because there's currency issues, there's all sorts of things that go on, and they can be a great investment or they could be terrible. I'm not telling you to do it. I'm just showing you valuations in comparison. You look at bonds, right? So U.S. bonds, 0.7%. I don't know what they're looking at. I have to look up which one they're I think it's probably a 7-year bond. But the short terms aren't. Short terms are getting 4%. You look at international hedge bonds, it's negative 0.2. Emerging market debt, 3.9. U.S. inflation tips 0.9, U.S. cash 1.6. So, these are their research projections. Are they right? I don't know. But these people are highly regarded, and I think they do a really great job at looking at valuations. So I want to throw it in there because I want you guys to see this and see, I'm not the only one yelling from the top of the mountain. There are many other people doing it. I'm just yelling loudest, but these other people are still doing it. So here's another one. This is Hussman. They have great research, although they're historically bearish with their research. But I just wanted to point this out. So if you listen to them, the world's always ending with them. But they do unbelievable research. So the conclusions may be a little off, but the research is second to none. So if you look at this is showing high valuations. So they're highlighting above the curve. So they're looking at basically risk premiums. And I don't want to dive in deep. This is a deeper topic, probably put people to sleep. But it's basically measuring risk premiums. And so it's showing that really it's like 1650 is where the S&P should be, or 1900 based on risk premiums. I don't know if that's accurate, but it's something that you should kind of bake in and say, okay, it's another data point, right? Another data point to look at. Historically, things have kind of operated within a certain volatility. When they get expensive, things tend to crash. They tend to bounce down to the line. So, we've got a bit of a drop if that happens. But I just wanted to point it out because it's a really good data point to consider. Next one, also from Hussman. This is matching up the actual percentage loss in the S&P 500 over 3 years compared to the estimated S&P 500 loss to restore the greater of 10% nominal return or risk premium. I don't want to get into that. I'm going to bore people. But the point is, look at historically, look at the relationship. The relationship is typically the losses. They map really close to the estimated losses based on this metric. We're way off. I mean, we're way off. We should be down. And the listeners of the show should recognize that I've been saying we should have between 40 and 60% drop from here on the index, on the S&P 500. That's what I think should happen. Will it happen? I don't know. But according to this metric, that's very in line. It looks like about 50% drop from here, somewhere thereabouts. So if you look at these things, just take it as another data point and say it's way off. Don't say this is the only data point. I'm going to hang my hat on it and I'm going to scream and yell based on this data point. It's not one data point. It's an aggregation of data points. And here's the last one I think we showed before. And this is the Case-Shiller Home Price Index. Uh, Home prices increased 40% and they've only dropped like 3% off the peak, even though the affordability has basically been cut in half for everybody. So if we went back to where we were right here at this data point in 2020, we would be more reasonably valued. This would be an equilibrium where I don't know that I would buy, but you could buy and feel good because your payments are going to be in line with an equilibrium. It won't be a great deal, but it'll be reasonable. You can afford it. You'll be able to afford back to where we were in 2020 before things got crazy. That would be an equilibrium. So that's a good thing, right? That's when you want to consider buying. It doesn't matter what the prices are. I mean, ideally you want the price to be lower, but if you're going to buy and hold long term, this is what you should be looking at. Where is it going to be close to equilibrium? 40% drop right now is equilibrium. When mortgage rates start to drop, that won't be 40, it might be 35. So it'll come into a balance. But I really just wanted to point these metrics out because the valuations are so important when you're looking at markets, when you're looking at whether you're going to invest or not, what you're going to invest in. I mean, you could find a great value. We could have the most overvalued market ever. And, let's say Apple drops 90% tomorrow for no reason whatsoever, and you can buy it at 90% discount. That's a good discount. Doesn't matter what the market's doing. So you have to separate the individual investment from the market, but use the market as the gauge for whether you should be looking at all of these equities. So if the index was down like 60%, I would say, give me a net. I'm going to go run around catching great values in this net, and I'm just going to go to town. But if it's expensive, I'm not really looking to the same degree as if it's 60% less, because the likelihood of finding a value is not good. So for an example, I'm not going to use a name, but let's just say they changed it's a big tech company and they changed their name recently. And you probably looked at your pictures on there frequently. So this company was overvalued. It was a FANG stock. It was doing really well, and then they changed the company name and it plummeted. We're not going to get into why or anything like that, but it plummeted in value. Now, from a valuation standpoint, I looked at it and I said, "Wow, this is actually in range of what I would buy." I would say this is a great deal. Now, I know personally I wouldn't invest in it for many reasons because there's just other stuff going on there that you're not going to see in the numbers. However, what happened to it brought it within range. I was like, oh, this is a bargain. Now, once I did, so it made me look into the numbers, right? I said, great, this hits my valuation metrics, even though the market's overpriced, and this may bring the stock down even more if the market crashes. However, it's within a valuation I could say, you know what, I feel good about this valuation. I think I can handle this and sleep at night, right? Even though it'll be volatile, I feel good about that. Now, once I dug deeper, I realized I don't want to do it. But the point is it hit that metric for me, even though things are expensive. So I'm still looking, but I think overall, I would really just throw everything out. If the markets drop 60%, I would throw everything out and say, all right, we're just going to dive deep into everything and we're going to find great values, great companies, perpetual cash flow generators, and we're just going to build a whole portfolio of those. But I can't do that now, right? And value investors are having a hard time doing this too. You can find values out there, but it's really hard. And if you have to compare that to bonds, we showed the number right earlier a few slides ago. We showed bonds, and the relationship between bonds. I think this is a little bit low, but I mean, if you can get a positive return on bonds, I mean, right now we're getting 4 to 5% depending on what you're looking at in U.S. Treasuries. How do you beat that? How do you take a chance of losing 1% a year over 7 years in equities when you can make 4 to 5% for a few years in U.S. Treasuries? To me, it's an obvious setup of, and this is going to be hard for people to get. So I'm going to take a minute here to explain it, and then I'm going to go back to Doug because I'm monopolizing the time. But I know Doug's a little under the weather, so I'm trying to do more and give him less today. So if you look at it this way, I'm going to give you a scenario, okay? And I want you guys to think about it. It's really important to think about. If you're just going to blow this off, just stop the podcast and just turn it off. But this is one of the most important things that I could give you, and I've given you a ton of important things in this podcast. So you guys have gotten a ton of value for free, so you're welcome. So think about it this way, right? Let's look at a 7-year period. Okay, let me make a few assumptions. So take these assumptions and think about it. One assumption is we have 5% U.S. Treasury bonds for the next 5 years or 7 years. Let's say we say it stays at 5%. We just have to make some illustration. 5% a year for the next 7 years. Okay, that's part one. Now let's assume the equity markets are going to be volatile, but they're basically going to get zero return over the next 7 years, right? They'll probably go down a lot, right? They'll go down like 30, 40, 50%, and then they'll come up. But if you look at 2000, 2013, for that 13-year period, the markets basically went nowhere. They went up and down a lot, but at the end of that period, you had zero return. So you lost 13 years of time, okay? That's what happened. If you look at the visual, you'll see it'll be crystal clear. But so I would look at a chart, go in a chart and just look at those periods and you'll see exactly what I'm talking about. So if you're getting 5% a year for the next 7 years, that's going to, well, actually, if you get it for 12 years, I believe, I think it's 12 years. If you get 5% a year for 12 years, you've doubled your money. So if you look at 2000, I'm going to change the scenario. Sorry to confuse everybody. Let's look at 2000. If you had gotten 5% a year for those 12 years, you would have doubled your money. Okay, just rule of 72. If you started with 100,000, you'd have 200,000 at the end of the 13-year period. If you were in equities for that 13-year period, you would still have 100,000, but you would have lost 13 years of time. So the example I'm trying to show is that if you're looking at a full market cycle and you're looking at equities, you're saying, hey, I have to have equities because I need growth. You don't. You don't need equities, right? If I could get 10% a year on 30-year US Treasuries, I would do it. I would have no equities. That's a great return, right? And I'm not saying you should do that. I'm not saying we'll ever see that again, but it's a really good return. You shouldn't look at equities as getting a better return than fixed income. You should look at it as what is the highest and best use of my money today? What is the best risk to reward trade-off for my money today? You can always change it tomorrow, right? Things change, you can change your mind. As of today, fixed income or CDs or US Treasuries look really attractive in comparison to everything else. So I point that out because I know people are going to listen to this and they're going to say, yep, I hear you. And they're going to go back to investing in equities. I have 100% of my money in equities. You could be a college student and it still makes sense to put your money in fixed income. Okay. I know this is weird because everyone's taught you need to be in equities if you're young because you need to take risk. That's stupid. Okay. It's stupid advice. Everyone gives it. It's basically non-thinking advice. It's like saying, hey, I'm going to sign up to be stupid. Hey, can you take my money? Yeah, I'm dumb too, right? And I'm not saying everyone here is dumb. I'm saying that the framework that has been given to you by Wall Street is you got to invest. You got to be in equities all the time. You got to do this. You got to do that. It's nonsensical. It's basically saying if you're not going to think about your investments the next 50 years, follow our advice and it'll probably be true. Does it mean it's the best thing for you? I don't know. I mean, maybe if you literally are not paying any attention, don't care, why are you listening to this show? All right. If you listen to this show, you're smart. We have smart listeners who listen to this show. They want to invest better. They want to learn. They want to get value from their investments. So if you're smart, which the listeners are, then you should be looking at this framework as a way to invest. And don't assume you should be 100% in equities. I mean, frankly, you could be 100% in fixed income nowadays and still be in a good position. I'm not giving advice. I can't do that in the show because everybody's different. If you need advice, please contact me. I'll provide it, but I can't do it on the show. So, but think about the framework of fixed income is not necessarily less risk than equities. It's not necessarily a less return. It could be a better scenario. Right now, it is a very attractive position to look at fixed income over equities. So just that takeaway, Doug, I'm going to hand it off to you before we wrap it up here. So what are some of your thoughts, Doug? I've been doing way too much talking.
Well, I mean, Kirk, what you're talking about is what often is referred to as risk-free. And I apologize for those who can't see me. My camera's still giving me fits. But it's risk-free trading. I mean, so what they generally look at is what can you get by putting your money somewhere related or somewhere in comparison to risk-free. And risk-free, Now, there's no such thing as risk-free, but it has historically been deemed to be what can you get on short-term treasuries, okay? Because you know that once the Fed has come out with those interest rates, that is something you're going to get. And of course, if you hold it to maturity, you're going to get paid on it. So right now, when you're talking, and I love what you're talking about because I see this all the time on the FinTwit, they call it financial Twitter. It's and I saw a great post from someone the other day. They said if you're trying to start another profile on Twitter, I'm going to butcher this, but he basically said just telling people to invest in the S&P 500, get a new gig, right? Because there's so many people on Twitter, and all they say is invest the S&P 500. It's the only place to be. They've grown up watching the markets just have an incredible run since the late aughts, and they've also grown up with a lot of advice that they've read in books by a number of different people that tell them that this is just the best way to do it. And the reality is that is not always the case cyclically. If you go back to the 80s, you look at what, like you talked about it, Kirk. Gosh, if you could get, bonds. I remember seeing situations where people were getting 18% interest on their cash in the mid 1980s just to do nothing, to have it sit in a bank account. Bonds were paying over 20% at certain points. And if you could get that kind of interest and know that you could just hold it to maturity and get paid on it, what's the point in putting it something that now has risk? The point of putting it something as risk is based on risk return. And you have to truly understand it. And unfortunately, I listen, as I said, I look at what's being posted out there through all sorts of social media, through all sorts of blogs, and people have forgotten what this means. They don't have a clue. They sit there and they look, well, the S&P 500 is going to get me, 8% a year, or as certain celebrities say, you can get 12% a year by investing in these quality growth stocks, growth mutual funds. You might know who I'm talking about. Guess what? That hasn't happened in 20 years. Okay, the return on the S&P 500 just since 2000 is barely around 7%. That's it. That's an entire generation of earning. And if you're basing your financial outcome off of these numbers, you're going to be sorely disappointed. And if you don't adjust to where the economy and the markets are telling you to be right now, like Kirk said, if you could get 3, 4, 5% on short-term treasuries, and the outlook for stocks heavily overvalued is potentially going to be stagnant or negative, which I don't know. We've seen that before, 2000 to 2013-ish. You're going to have to change your thinking. If what you thought you knew was true turned out to be untrue, when do you want to know? I say this to people all the time. And this is something where you can either choose to reject it or get a bigger box of knowledge and think differently about it. Because ultimately, if you can get 5%, 4 or 5%, and that's considered safe money, again, it's going to pay that interest. And your outlook of these stocks is not going to get anywhere close to what you've been told you're going to get. You might, like Kirk said, even if you're a young person, it might be the time to invest in bonds. Now, would you do that for the next 30 years, Kirk? Absolutely. Well, probably
Not
not.
now, not now, not with the rates that are 30 years now. But if you were giving me 15% U.S. Treasuries, I would do 30 years. Absolutely.
Absolutely. Well, if they gave you a 30-year treasury,
Right.
what I'm talking about is, would you change your allocation to just invest in bonds for the next 30 years, generally speaking? And the answer to that's no. You have to adjust with the tide. You have to flow with the tide. And right now, we're in a situation where it may be one of those moments where everything you thought you knew was true turns out to be untrue. And it may be better to have a higher allocation of fixed income. Now, I'll go back 18 months ago, and guess what? Same concept, completely different result, was the old philosophy of, well, the best way to keep a portfolio safe is to have a higher equity, a higher allocation of bonds, right? So if you're more aggressive, you should have 100%, up to 100% in equities. If you're completely conservative, you should have up to 100% in fixed income. How did that work out for people? In 2022, when they raised interest rates, the worst performing allocations were the ones that had been sold or taught to be the most conservative and the safest. Because again, the scenario, the metrics didn't necessarily add up in that situation. And that long-term bull market in bonds was about to take a severe hit when the Federal Reserve started raising interest rates and crushing the valuation of long-term treasuries that were wonderful when they were at 3-4%, and years ago when interest rates were less than that, at one point, on the verge of negative. But all of a sudden, when the Federal Reserve raises those interest rates up on new issues to 5, 6, 7%, all of a sudden those long-term bonds plummet to earth. And so now that's reversed. Now those valuations have been completely reversed. And the new issue of what's available, at least on short-term bonds, is a lot more favorable. And that makes now a different kind of reality than even 2 years ago.
Great. Well, appreciate that, Doug. We're going to wrap it up here. Where can people find more about you? And we'll take it home here on this Friday.
Well, you can't talk about interest rates if you're not thinking about student loans. And if you think about student loans, it means you got kids that are going to be going to college. And I'm sure, and if you're thinking of kids going to college, you're thinking of inflation and costs. Listen, it's overwhelming for a lot of people. It doesn't matter how much money you make. College is expensive. If you want to plan to do it, we have a 9-step program to help people get through this, solve this problem, to help save money for college, to put a plan together, to protect your retirement. Go out right now, procollegeplan.com, download our free checklist. If you're going to do anything else, get that checklist. It's the 2022, 2023 key numbers. We update this annually, so stay on top of it. But go to procollegeplan.com right now, download some free materials to help get you started for a better plan for college.
Great. Well, Doug, thanks for coming on the show. And that's the show for this week. Thank you again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. Please remember to subscribe to the podcast in the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archived shows. Also, we're now on YouTube, so please check out our YouTube channel. When you're there, please subscribe and leave a comment. Those of you who are watching live on YouTube, you're probably thinking this is redundant. Lastly, please leave a show rating and comments on the podcast after your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling you any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. If you're seeking financial advice, talk to an oracle or a fortune teller or maybe a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.